In this video, we're going to look at how to find your trading edge if you are a beginner trader. You might have already heard some traders say that you cannot be successful as a trader until you have an edge. But what does that actually mean? And what practical steps can you take to find your trading edge? We're going to answer those questions in this video. So if you're excited to learn, hit the thumbs up button before we get started. And if you're interested in more beginner-friendly content like this, hit subscribe to Thinkmarkets now as well. So first of all, before I tell you how to find your trading edge if you are a beginner trader, we're first of all going to look into what a trading edge even is. And to understand a trading edge, we need to look at a bit of basic probability. So in trading, you can buy or you can sell. You've got two options. If you flip a coin, you can get heads or tails. Again, two options. Let's look at the coin flip for a minute, because it's an example that a lot of people can understand and can relate to. You have these two outcomes. So in theory, you've got a 50% chance of getting it right anytime. And over a large amount of coin flips, you still have a 50% chance overall. You might get heads 3 times in a row, but over 100 coin flips, you'll still end up getting 50-50. So this is called the law of large numbers in probability, and it's very relevant in trading when you are looking for your trading edge. We're less interested in how we do over 3 trades, but rather more interested in how we do over a large amount of trades over a longer amount of time. If we were randomly buying and selling with no real edge, in theory, we have a 50% chance of being right. In reality, we'd actually be down because we still have to pay the broker fees every time we place a trade. So it's very important to have an edge so that you can give yourself a statistical advantage of making more profits than you make losses in trading. An example of an edge in a coin flip would be if you weighted one side, then you'd have a statistical advantage of actually having that one side come up higher than 50% over a large amount of coin flips. So let's have a look at how you can give yourself a statistical advantage in trading over a large amount of trades. So one of the most obvious ways is to cut your losses short and let your winners ride out. So in this video, I'm going to show you 3 ways that you can cut your losses short and let your winners ride out. And that is by using a risk to reward ratio, by journaling and analysing your profit and loss, and by compounding. So let's look at risk to reward ratio first of all. I'm going to use up a position tool here. So let's say we can see the market going down. So I'm going to use a short position tool on this example. Let's just put this one here in the middle. So here we've got our stop loss. If we guess that the market's going down, our stop loss is up here and our take profit is down here. The risk to reward ratio on here is 1-to-1 at the moment because the stop loss and the take profit are the exact same amount of distance from the entry point. Now let's say, for example, we make the stop loss 30 points and we make the take profit 120 points. Now we have a risk to reward ratio of 1-to-4. It means that our losses are going to be cut a lot shorter and our winners are going to be left to ride out. This means that if you are right 50% of the time and 50% of your trades hit take profit and 50% hit stop loss, then although your strike rate would still be 50-50, you would actually end up being more in profit because your profits are a lot larger than your losses. So if you want to be using your risk to reward ratio as your trading edge, you want to make sure that it's definitely bigger than 1-to-1. You want to make sure it's at least 1-to-2, but actually you want to be looking for setups where it's as high as possible. Some traders even look for setups where their risk to reward ratio is 1-to-20. I personally tend to use this one where it's around 1-to-4. Even 1-to-3 or 1-to-2 does still give you an advantage, but it very much depends on what your strike rate is as to what your risk to reward ratio needs to be. So the next idea that we're going to look at is journaling and analysing your profit and loss. So I've worked with a lot of traders over the years, and one thing that's very surprising is how few of them actually understand where their losses and their profits are actually coming from. They will often make a guess as to what their losses and their profits are, but very often at the end of a trading day, traders will feel so exhausted and emotionally drained, especially if they are placing lots of trades and over trading. They might feel so overwhelmed by the whole situation that they actually aren't analysing their profit and losses, and they're not journaling and rereading over their journal entries. But this is a big mistake, because as soon as you understand where your losses and your profits are truly coming from, you can start making practical steps to eliminate those losses and let your winners ride out. So one example from my own trading experience is when I started journaling, I realized that most of my wins were coming from when the market was in a trending market on the day chart, and most of my losses were coming from when it was consolidating on the day chart. So even though I'm actually trading on the 1 minute chart, this means that if I add an extra step of looking at the day chart first and establishing if we're even in good conditions to place a trade, this was helping to give me an edge, because I was able to cut a lot of the losses and I was able to only take advantage of those really good setups. I'm going to show you what that means. If we just head over to the day chart and we have a look at how the market looks. Can you see how there'll be entire times on the US 30, which is the market that I trade, when the market is in a nice downtrend or a nice uptrend? These are the times when I was getting really, really good results and it all seemed very easy. But then when the market was consolidating and it was going sideways and we were getting a lot of wicky candles, not really going in any direction, this is where I was taking a lot of losses. And as soon as I analyzed my journal entries and my profit and loss, I was able to see very clearly that if I just cut out these areas, I was able to give myself an advantage. What wicky candles going sideways on the day chart looks like on the 1 minute chart is candles just going up and down with a lot of volatility. Journaling your trades and reading back through your journal entries and also analysing your profit and loss can be a great way to give yourself an edge in trading. And the third step is compounding. And again, this relates to how the market is moving on the day chart. Can you see how the market sometimes has these nice long uptrends or downtrends, and sometimes they go on for months at a time? So one little trick that you can do to give yourself an edge is, rather than closing your entire trade at the end of the day, you can leave just 10% open with your stop loss at break even. A lot of the time this will actually get hit and that trade won't stay open for very long, just because of the way that the market moves. It does often come up and down even when it's in a trending market. But for the few times that that trade will actually stay open, you've got a small amount of a trade which will stay open for months and months, and it will continue to compound as the market moves through the trend. So this is a really nice little trick for letting your wins ride out for as long as possible. If I want to know when it's a good time to close those small little bits that I've left to compound, I'll use Heikin Ashi on the day chart. Heikin Ashi shows you when you have momentum in a particular direction and when it's slowing down and when it goes indecisive. So whilst the market has momentum in a certain direction, if you leave a small amount open, then you can let that compound. When it starts to consolidate, or when it actually changes direction to the other side and gains momentum on the other side, that's a good time to close those small parts of the trade. So now you've got some ideas as to how to find your trading edge. The next step is to practice your strategy on a simulator. So if you head over to the Traders Gym on Thinkmarkets, you can use the simulator there using virtual money. I would suggest testing it out at least 100 times. This is a large amount of trades, which means you'll get a good idea about what the probability is over a large amount of trades. I would also suggest having a look on the day chart and seeing that the market is in an uptrend, a consolidation, and a downtrend when you're testing it out on the simulator. This means that you've got a good cross section of scenarios for when you actually go live. If you're just testing it out on a simulator when the market's in an uptrend, you might find that if the market then goes into a consolidation when you're trading live, you're not getting the same results. I hope you found this video helpful, and if you're excited to go find your trading edge, hit the thumbs up button now.